Hello, everybody. This is Dave Barnett with Attract Capital. We're broadcasting to you live from Bridge Capital Solutions in Hapog, New York. And I'm with Michael Casalini, who's the Chief Executive Officer and founder of Bridge Capital Solutions. We welcome everybody today to the masterclass where we're going to be talking about how Michael and Bridge Capital Solutions greatly increased the size of his business using mezzanine funding. So Michael, I appreciate you spending the time with us out of your busy day. You've had a very interesting journey with mezzanine financing over the years. I first met you back in 2009. Your business, you had a great business at the time, but it was considerably smaller. And we sit here 8 years later, and when I was looking at the numbers, you've grown your revenue at least 5 times from where it was. You've grown your profitability dramatically. You've done some different things in terms of getting into new lines of business and becoming more of a technology company. So there's a lot to talk about here today. Before we get to that, why don't we just talk a little bit about what Bridge Capital Solutions is, and we can set the stage, and then we'll go through the questions.
Sure, Dave. Well, Bridge Capital Solutions is a commercial check cashing business. And when people hear those words, they tend to assimilate me to check cashing, and I couldn't be further from that. We specifically deal with small businesses, and we just help them eliminate the bank out of the float process when you deposit a check. So we provide same-day availability of funds. So we started off doing that it happens to be in cash because our license only enabled us to cash checks. So
you speed up the
availability process
for small businesses and for a lot of trade-related contracting businesses.
It's definitely trade-related services companies. And meeting you in 2009 was really fortuitous for us because in 2008 we were on the heels of the banking crisis, and
that's right.
Our ideal customer was the customer who always found themselves uncollected or overdrawn in their bank account, and the banks would normally just pay on it for a fee. Well, after the banking crisis, those services started to dry up for our level of customer, and we specifically deal with businesses that do under $5 million a year in revenue.
So you're dealing with really small, medium, SME, SMB type businesses,
yeah.
And the banks really clamped down on that overdraft. So whereas they used to be able to be overdraft in their bank account, no longer. They were paying big fees, and so that's why a lot of
losing their banking privileges altogether.
Okay.
Being asked to leave the bank and having to find a new bank relationship. And our customer base found themselves in the ranks of unbanked or underbanked, which describes a retail check cashing customer, a person who gets a check cut to their name, being unbanked or underbanked. And this is a whole new feeling for this customer base.
And that really started, Mike. I mean, if I look at some of the history, but the term unbankables or non-banked really came in vogue in like 08 and 09 because banks had to make hard decisions about how they were going to allocate their precious capital, and they kind of looked at the small business users and said they're not as lucrative. We don't want to support them as much with their capital, so it really opened up a nice hole for you to be able to fill.
Yeah, correct. We truly are a counter-cyclical business, and it's because we provide the services that the banks should be providing. So we're able to fill that gap and expedite immediate availability of cash flow to our customer base.
And so when we met, you had already been looking for capital, and the type of vision that you had originally was to take this service and to expand it. So you were looking to grow organically. You weren't looking for an acquisition at the time.
No, and our banking partners were limited, and they kept coming back to the same answer from every bank, whoever we approached. We needed equity to lend against. So the money we made had to be invested into a building or other types of equity for them to use as collateral to borrow against. And we found ourselves trapped in a hole because our whole business is cash availability, not only for our customers, but for us, because our inventory is cash, and cash isn't considered an asset.
See, that's the funny thing.
Which is a totally ironic concept to me, but yeah.
To many people, cash is the ultimate asset, right, Michael? So it's funny because what you're saying is that because you didn't have hard collateral, the banks didn't know what to do with you in terms of their classifications of businesses to lend to.
Correct.
And even though you have a lot of cash, because cash is your inventory, you're basically selling cash, you're exchanging cash for checks, they couldn't comprehend that, and that's not an asset that they were comfortable making a loan against.
And the time I met you, we had been self-financed. My partner, Greg Augerberg, his family was very generous and believed in us, and they supplied 90% of the capital we needed to grow the business, which is about $1 million in capital. And we had basically reached that limit because we could only cash enough checks for the amount of cash that we had. So we were limited to our growth. So we were basically fighting cash availability every day.
So in your business, Michael, if you don't have cash on hand, you really can't stimulate more demand from the market.
Correct.
To come and exchange the checks for the cash. So you needed to sort of grow in stair-step fashion where you had grown very rapidly before I had met you, but then you were getting ready for the next level of growth. So let's talk about when you and I first met on Mezzanine, and you started your Mezzanine journey. What was the growth objective that you had, and what was the process that we used to help you get there?
Right. So before we had met you, we'd met a couple of other firms, and they were looking to charge large sums of money to write a book to get growth capital, that they called it. But they kept throwing terms in like acquisition terms, and that really didn't fit our niche of what we wanted to do. We wanted to grow organically.
So they were really looking to bring a kind of a predetermined structure to you.
Correct.
As opposed to looking at what you needed and kind of figuring it out based on your custom situation.
Correct. We knew the market that we had ahead of us. We knew we had a database of like 70,000 businesses that fit our criteria of customer. We didn't need to acquire anybody else's business because that business isn't what we wanted. We were defining a whole new banking product and had identified the customer that will fit this model. So there wasn't anything to acquire other than customers. So we needed growth capital to acquire those customers to facilitate those transactions.
And in terms of when you were first exposed to the mezzanine lenders that we introduced you to, how did you see it originally in terms of what they can offer you? I mean, in terms of the funding that you needed, what was it going to enable you to do? And sort of how did those funds measure up against some of the other alternatives you were thinking about? You mentioned like Greg's family had put in equity. You mentioned that you were talking to some other investment banks that were talking about bringing in equity, et cetera. But how was it going to help you, the dollars, and what was an alternative to you doing at the time?
Right. So when we met at Attract Capital and yourself, and you provided a different vision than what we were hearing, and which was important, which was you truly wanted to take the time to understand what we needed for the capital for, and to understand the mechanics and inner workings of our business and what made our business tick, and to be able to acquire customers. So it was pretty simple. The more cash we had, the more business we can do.
That's right.
So, and it wasn't more simplistic than that. It wasn't that we needed the cash to buy equipment. We needed the cash to expand our location. It was basically simple. I needed more widgets to sell, and my cash is my widgets, and I need that. And that was the hardest. In its simplicity, it became quite a challenge because nobody wanted to look at the cash. The cash is unsecured basically because it's sitting in a vault.
Right. It's unsecured. It's fluid. It's constantly moving through the system. You're constantly having deliveries of armored car companies that you're dropping off cash. Cash is going out the door. It's not locked up in a factory somewhere. So, and I remember that kind of highlighting that point. But I also think what I was impressed with when I first met you at Bridge Capital is that you had this intense understanding of a process and how to qualify these checks. I mean, you had some incredible record where you had accepted maybe $150 million worth of checks, and you had only $5,000 worth of write-offs. So you had risk mitigation procedures. You had elevated your risk mitigation procedures to an incredibly high level, and you had set up this process of just making sure that every check that you were taking and exchanging for cash was a good check and was going to be collected. And that's what really impressed me about your business, in addition to the sales and the marketing, but just the fact that you had put this risk mitigation system together and you were able to execute it consistently across thousands of different customers, across tens of thousands of different transactions. it was almost like a foolproof system, and that's the beauty of your business in terms of
Right. So when in the beginning you asked me to describe my business, and we say we're in the commercial check cashing business, but it's really what the heart and soul of our business is risk mitigation processing. Right, how to process and assess risk in real time.
Correct.
And from a multitude of different angles. So that's really the core business that we do, and we just apply that processes to our business to be able to grow our business.
So
without growing losses.
So we came in, we asked you a bunch of questions about to get to the bottom of it and to understand it at a more granular level. We put together this confidential information memorandum. Now, maybe talk a bit about how the confidential information memorandum was really a tool for you to think at a different level, or was a tool for us both to go out and target the types of lenders that we wanted to build a relationship with?
I think that was probably the most integral piece of this whole journey. It impacts not only the explanation of our business, but the relationship you're going to form with your lender afterwards. Right, so going back to the firms that I had met before you, they said we're going to write you a book, and the book is going to tell you how we acquire capital for you, and the approach that our advisor, Attract Capital, gave us was, you're going to understand what it is that makes us unique, what it is that makes us profitable. You're going to articulate that in a form so that somebody else who doesn't know my business can get quickly, okay, without going into too dense of material. And that helps set the stage for your relationship with your lender going forward, because you're in line, you're in tune with what your vision of the growth of this business is going to look like over the next 3 to 5 years. It also helps set expectations of what you're going to grow into, and it helps provide transparency if you're deviating from that in any way, so that you're all playing by the same rules.
That's really, the way you just said it is probably clearer and more succinct than I've ever said it over the last 17 years. But I think what we tried to do in your situation is put this framework together to describe what was special and unique about your business, and put it in the language that a mezzanine lender would understand. Because mezzanine lenders think differently than banks and investors. They analyze differently than banks and investors, and so being able to take your information, understand it, and express it, and get it to those lenders and articulate it, it's almost like if they see what we wrote in that confidential memorandum, we want to talk to them, and they're a smarter partner. And I think in many ways, it allowed you, putting that SIM together and getting it in front of certain lenders allowed us to attract the type of lenders that we wanted, and really help start the relationship off on the right foot, because they really got it.
Right. So I think another key factor in what you brought to the table with us was, all right, so there's a universe of mezz lenders out there. There's maybe 1,000 mezz firms, let's just say. Not every firm is going to write this deal for you. So the book enables us to translate a message to them that, well, let's face it, everybody's excited about their business. But if you're a mezz lender picking up a book and reading it, it's like reading stereo instructions every single day, right? So you have to sit there, and what's going to differentiate your book? So you have to make sure that you put your book in tune with the people, that their mission as a mezz fund, okay? Each mezz fund has its own mission that it wants to fulfill, okay? Mm-hmm. Is it a growth acquisition? Is it a technology firm? Is it a specialized in banking? Does it specialize in anything else, okay? Your firm helped us isolate the firms that that would be our business model would be appealing to, so that when they're reading the model, it's not stereo instructions. It fits with their core criteria, and you get to differentiate yourself between the other books that they're getting on a daily basis. Say, oh, you know what, this meets my criteria of my firm. Let me read a little bit more about it. I think that truly is the key.
So I'm glad we're writing books that are not stereo instructions.
Exactly.
my work is finished. Right. No, that's really good to hear. One of the things about mezz is that, it's differentiated from asset-based or collateralized loans, and it's also different than equity or investment that comes in. When we were presenting your deal to the lenders, we always were presenting the future. We were presenting what the business could become with the pieces of the puzzle that you had in place. How do you, and you have a very unique vantage point, Mike, because you've had 2 different mezz lenders, and we'll talk about your general experience with them in a little bit, but how do you see their orientation in terms of how they think about their loans and what you're going to do with the money? Like their basis for making a decision. How is their basis for making a decision relevant to a company like yours?
That's a great question. And I think that's what I think the answer truly defines what Mezz Capital means to business today, as opposed to what traditional banks like. So, in our history, in going out and finding money before we, settled with Attract Capital, was the banks would look at what your tangible assets were to be able to formulate a capital structure to go on your assets. What can we borrow against what can we afford to lend you based on your assets? Well, our asset was cash. Mm-hmm. Can't lend against cash. They don't look at it as an asset because of liquidity that we discussed.
So in the using the wording a bank would use, you're an airball deal.
There's
right.
No collateral. There's no collateral, right? So, which really speaks to me is what you've accomplished in the past. Okay, what trophies do you have from your accomplishments in the past that we can lend against? Right? Mezz deals are completely structured a different way. They look at what the growth potential of your business is, and they will take a risk-based approach on your future growth potential, and they will lend against cash flow or profits in the future. So in a lot of ways, mezz debt represents future growth, as opposed to traditional banks represents past accomplishments. And that truly, to me, is really what we needed as a company, and we could not have grown had we not moved with a mezz firm to do what we had to do.
I think what you said is spot on. It's lending based on future growth, and it gives you the money that you need to be able to accelerate to that future growth state, as opposed to money based on historical
and
growth.
That goes back to why the book is so important, because the book lays out the rules as to what the expectations of that growth is supposed to be.
And if I remember correctly, Mike, we got quite specific in that growth plan. We talked about how many customers you were going to have per year. We talked about what the average check size was going to be. We talked about what your percentage. We talked about the staffing ratios in terms of how much capacity. And I think what we were able to do is kind of make it was sort of color by number, so that the lender can look at it and understand that there was a dashboard level of metrics that you use to think about your business in order to scale it, which really worked to your benefit.
Yeah, and after we had secured the funding, and by the way, going through the Mezz lending process for the very first time was a very eye-opening experience. I don't come from a financial background. I come from a construction trade related service background. So a lot of concept. I had to get used to what EBITDA was. I had to get used to how to do my books in a way in which or translate to lending vernacular.
See, that's an important thing, because at the level that you were at back then, there were a few things that we had to remediate almost and kind of get up to a certain standard, so that the lenders, and making sure that your financials were in GAAP, and that the expenses were categorized. And then we talked about this concept, which I think we've talked about to the Attract Capital audience in the past, about add backs and EBITDA, adjusted EBITDA, and the creativity, the subjectivity that you can bring to just ordinary expenses, and how it's not always black and white, it's a little bit of gray. But how have we dealt with that little bit of gray in terms of your business, in terms of the creativity?
Well, when we originally looked at Ideal, we were looking at maybe $250,000, $300,000 worth of EBITDA, that you would call, and you were looking at it saying, well, I know there's something here, but I don't really know what's here until I get into the nuts and bolts of it. And after you were able to recategorize our expenses properly to fit GAAP and be in line with what EBITDA reporting would be, you basically picked up an additional almost $400,000 in actual properly accounting of expenses the way they're supposed to be, in one-time add-backs, extraordinary expenses, deposits for that prepaid expenses. I mean, legal expenses, what do they pertain to? I mean, how you categorize your legal expenses are important. So all these things together, helps you formulate your business which ultimately makes you a better business owner, because you're able to understand your financials on a month-to-month reporting basis to your lender, and you're in tune with your numbers every month. So I can honestly say, by getting involved in the mezzanine debt financing direction, it's been able to make me a better business owner, to be able to understand my business in a much more granular level, without having to rely on a CFO and those types of things. And basically, deal with these things by having to be the person who reports them to the lender. You're able to understand your numbers much better.
Wow, that's really high praise. But I think what it speaks to is that when you go through the process of setting out the growth expectations, and then you dig into the business and you get under the hood and you look at the financials and how everything is accounted for, when you can kind of fuse the two of them together, the growth story as we call it, and the historical pro forma construction as we call it, when you put the two of them together, you get a kind of a more analytical, more objective view of where you have been, where you are, and where you're going.
And more sensitive on where and when you're spending your money and how you're spending your money. So.
And really what you're doing, Mike, if you think about that, you're really thinking a little, you don't want to think 100% like a lender, because if you think too much like a lender, you're not thinking like an entrepreneur.
Right.
But to be able to think about your business critically and somewhat objectively the way a lender would think about your business has a lot of value when it comes to making certain big decisions, such as capital allocation decisions, such as growth decisions, such as hiring decisions. Those are important things where I think a lending discipline and a lending thought process, bears fruit when you bring that to the table.
Correct.
Let's take a little step in a different direction and talk about, so Michael's business, when I first met him, was a single location in Hauppauge with aspirations to grow regionally, and he has successfully grown regionally. He has another location out in the Hamptons. But through the growth journey that you had with your original mezzanine lender, and then we brought in a second mezzanine lender, you were able to see that there was an unmet need in your customer base. And by highlighting and identifying that unmet need, you were able to kind of almost recreate a completely new business opportunity for yourself.
Yes, which basically led to our second round of financing, mezz debt financing through Main Street Capital. We were able to put together, from a service-based company, which is Bridge Capital Solutions, meeting the day-to-day needs of the businesses on Long Island, we were able to put that in a technology-based application where we were able to come up with a digital product to be able to provide services on a national level, to bring in a national footprint of other locations throughout the country, to be able to provide same-day availability banking services through the prepay card, which
so you were able to become more technology oriented and to come up with a debit card that you can distribute nationally, and you did this all without raising equity from a growth equity provider?
Correct. Yes, we were able to provide growth equity through.
You're able to source growth
equity, from our new partner. But it all ties back to the performance of our core business. All right? Our core business has to keep performing at the numbers that we said they were going to grow, which provides you leniency to be able to grow this other avenue, because it's going to ultimately benefit the core business.
See, I think that's a great example, because what Michael was able to do is to innovate in a new direction, and it's a form of, the debit card is a form of vertical integration, and he was able to use his existing cash flow and the relationship he had with his lender to capitalize this new growth opportunity, which he's taking nationally, which is fantastic. So it's almost you've not only been able to scale your existing commercial check cashing business, but you've been able to launch a completely new digital business, which has national growth potential and could grow at a much faster rate than the existing commercial check cashing business.
Right, and what the debit card business was able to do was, we knew that our customers loved dealing with us, and we were only seeing about 25% of their overall business's needs because it was in cash, and the cash became a hurdle. So the debit card enabled us to get further into our customers' wallets to provide services. So we were able to grow our business with the same customer base, as opposed to constantly having to grow new customers. So you could double your growth with the same customers that you're already doing, because you're providing them currency in a different form.
You're getting more of their spend.
Correct.
They're already customers, you're offering them another service, and you're getting more of their money, and you're generating more income from it.
Which ultimately goes back to 2008, because this product winds up replacing what they lost through the banking crisis, which was overdraft or uncollected. So instead of being overdraft and uncollected, we got our customers to rethink their banking mentalities. As opposed to paying the bank at the end of the month, we do it as a pay-as-you-go service. So for a fee structure, you're able, by telling the customer the fee up front, they're able to account for those products going forward, and be able to say, hey, listen, I need same-day availability in my banking for a portion of my business, not all of it, but a portion of it, which winds up being twice as much of us. They pre-bill their services to their customers, so it winds up being a pass-through for them.
It's a great fintech growth story, Mike, and it's really amazing. And I think when I look at what you've been able to do with a mezzanine lender, it really speaks to, in my view, how well you've been able to build a relationship with both of your mezzanine lenders, and how you've been able to use them as a reliable partner to continue to fund your growth vision, because your growth vision has evolved, right? And you've been able to bring your lenders along with your growth vision.
Right.
So I think it's a testament to how great of a job you've done at being transparent, at educating them, at giving them the information that they need, at getting them to see that you're a completely trustworthy person, and because not everybody can do it, but maybe what you can, when it comes to relationship building, right? Because a lot of people, when they think about loans, they think it's just dollars, right? They think it's just a transaction. We need a certain amount of money. I maintain and attract capital that it's all about the relationship. We deal in relationships, we put people together, but we put good people together. We put good people on the entrepreneurial side together with good people on the lending side. And when you do that, and you fertilize the ground between the two of those parties, great things can happen. I think it's all about relationships. How do you see the importance of the relationship, because as you've gone through your mezzanine journey over the past 8 years?
Well, I think it's been the backbone of our success with our partners. When we started this, the very first deal we had was with Presidian Capital, and what they were able to do, and I think this is what most mezzanine vendors do, is they give you a person who you deal with on a monthly basis. They're your contact person, okay? Building a relationship with that contact person, because you have to look at it as you're one of many in a portfolio, okay? His job is to relate to his bosses how the performance of your company is. So building a relationship with the person who's ultimately telling your portfolio managers how you're performing is important, because you have to make his job easier to sell your story.
Correct.
So the more information you give him, the better it's going to be down the line, because the senior partners are going to be looking and saying, oh, well, how's that Bridge Capital doing? Oh, he's doing this, he's doing that, he's doing this. He missed a little bit on this number, but I can see where it's happening. He told me what's coming down the line. So the more information you can provide them, the better it is. Instead of maybe in the past, you never want to give your banker bad news, right? That's not the case here. You need to tell him where the speed bumps are going to be, so he can be prepared to handle your information in the firm.
You almost treat him, and because I've been involved in some of the communication, but you almost give them a very high level of disclosure, and you almost treat them like a silent partner.
Correct.
And if there's news if there's negative news, you kind of want to get that out even faster than positive news. And it's just this spirit of full disclosure, and that's how you've been able to build the relationships.
Yeah, it's been transparency. Just try to be as transparent with your lender as possible, to be able to treat them like a partner. And because technically they are. I mean, they're a partner. Yeah, you're paying them interest on a monthly basis, but they're a partner. They believe they're putting their capital in your hands to grow it. So you need to give them as much headroom as you can. And of course, they're going to be happy when you have successes. But to me, success is a double-edged sword, right? It's great to have it, but you have to continue to do it. And you've already laid out a pathway of success you're going to do in your book. So, it's not an accomplishment to have those successes, it's expectations.
And absolutely, Mike. And I think if you think about it from the lender's position, they only have one way out of your loan. They don't have any collateral. They have the EBITDA. You're the captain of the ship. You're the one who's pumping out the EBITDA. And so they only have one way out, and that's through the EBITDA, and you're the one that's captaining the production of the EBITDA. So they really need to believe in you, and they really need to believe that the EBITDA is going to be there, because the whole theory of mezzanine is that you're going to pay interest payments, and then you're going to start paying off the principal down the road, so the business has to scale to a certain size. And you've done a tremendous job doing it. I mean, to have grown your business at least 5 times over the past 8 years, given the economy that we had with its slow growth, and the fact that you've been in an industry, construction, supplying capital to trade-related construction companies where there hasn't been robust construction over the past 7 years. It's changing now, but you've done a really great job. What would you say, in a nutshell, in terms of the importance of having an advisor as you go through this process? Because what we tell people is, You might have gotten a bank loan, you might have gotten an investor, but if you're looking for cash flow loans and you're looking for this type of a lender, it's really a different animal and you need to approach it completely differently. What would you say in terms of the importance of having the right advisor?
Makes all the difference in the world. You know, I couldn't have accomplished those growth 1 times, 2 times, 3 times over had I not had the right advisor at my side to help me make those tough decisions. You know, all the news I've ever brought my lender has never been good, right? So there are bad. So you have to be able to position that correctly. You don't just pick up the phone and say, "Hey, hello, by the way, you know, it's hitting the fan today." You know, how do you translate that message, right? And having the right way to approach that and have the right advice of what and how to say it is important. Managing through the minefields.
I completely agree with you. I think I think an advisor that can take the time to ask questions, to learn the business, and who knows the market and knows quality lenders that are out there, who can bring people together and form a relationship is very valuable. And I think it's the gift that keeps on giving.
Right, and if you look at the Mezz deal on its face, it's not a long-term solution. It's a 5-year plan, right? So you know there's going to be something else happening in 5 years. How you deal with that early on is going to be key. So having the right advisor decide to make those decisions in 5 years is going to be important. So just because you close the deal doesn't mean the relationship should end.
Because you got to get the lender out someday.
You got to get the lender out, right? You got to look down the long road.
Easy in, you know, sometimes not so easy out.
Right.
What would you say, because we're getting some questions from the Attract Capital viewing audience, what would you say, some people have an innate fear of mezz lenders because they feel that they just want to take over their business, they just want to run the business, they want to take over the company, they want a loan to own. What would you say to people that have that kind of a fear? What is your relation, because you've dealt with Presidian Capital, which is a very fine mezz fund, you've dealt with Main Street Capital, which is a very fine BDC. How would you characterize how they deal with you and how it's been to deal with them?
I think that goes back to finding the right deal, okay? Picking the right mezz fund, right? Understanding, you know, just because a mezz fund wants to give you money doesn't necessarily mean you should take their money. Right? What is that mezz company's track record? What do they normally? Are they the type of mezz company that specializes in portfolio acquisitions and turnarounds, or are they a growth strategy? Are they more like a BDC, business development, company? Understand who your mezz loan is that's investing to you, and that's who you're depending on your relationship with your advisory firm to be able to put you with the right partner. So getting partnered with the right mezz deal up front is going to determine what your relationship is going to be in the back. So you can't be surprised if a mezz company invests into your company that specializes in takeovers and turnarounds. I mean, obviously, they're going to want to.
They're going to be more aggressive.
They're going to be more aggressive.
They're going to have an ulterior motive. But then again, to your point, it's knowable.
Knowable.
You can know on the front end what type of strategy they have as a firm. So we
speak to some other partners that they've lent money to.
Right. Exactly.
Have conversations with former clients. If a mezz company is not willing to be transparent with you as to who they borrowed money from or lent money to, then that should be a warning, a red flag as well.
But how have they, in terms of their intrusiveness, in terms of how they've dealt with you on major issues? My experience is that mezz lenders are relatively passive, and as long as you're paying their interest and you're hitting reasonable numbers and you're not breaching any financial covenants, that they go along with you.
Right.
You have to lead them. You have to manage the relationship. You've got a lot on your shoulders in terms of making sure that it works. But they're not interested in running your company. They're not interested in taking over the board. They're not interested in telling you what to do. You have complete 100% operational control of your business. That's been my experience, having been in the mezz business for the last 30 years. What has your experience been?
That has been my experience as well, is that they have no interest in taking over your business. Otherwise, they'd be in the business of taking over. They lend money
right.
to get a return. It's your job to provide the return. Okay, they don't get involved unless you're not performing. If you're performing, that's what the loan documents are so onerous. Those loan documents for mezz deals are not simple to get through. They're very complicated, but they have protocols put in place to be able to provide safeguards for the lender for the money. They're not putting you in the money in your business, unconditionally. There are conditions. You have to meet those conditions. You have to meet your covenants.
Right.
How are you meeting your covenants? If you're not meeting your covenants, you can't be surprised that your lender wants to get involved, right? But they get involved. They don't just go from, oh, you missed this one covenant, we're taking over the entire company.
Right.
That they don't. It's not within their best interest to do it. Their best interest is to protect their investment. You're the first line of defense in protecting that investment, performing as per your loan document and your covenants. That's why getting the right advisor to set the loan document up front is important, because you want to make sure you don't set unreal expectations in your document. If you say you're going to do X amount of revenue in year one and you don't, you need to be able to A, prepare to how you're going to deliver that opportunity, but B, manage your way through it. They have no interest in coming in to manage your company.
Extremely well said, Mike. I couldn't add anything to that. I completely agree with you. They are dependent upon the management team to run the business, to achieve the budget, and to produce the interest return for them as a company. And as long as everything is on track, they don't get involved. If things fall off track and if there's a major issue, they might get a little involved. They might send in a consultant. They might send in an accountant to look at some of the numbers. But most of the mezzanine lenders that I know, and I think the ones that you know, they don't know how to run companies by their own admission. They're not operating experts, nor do they have any time or inclination to want to run their company.
Right.
But, well, listen, what 3 tips would you have as we finish up here? And this has been great sitting with you and talking to you about your mezzanine journey. But as we try to put an exclamation point on this for the viewing audience, if you had 3 tips to give to somebody who's considering this type of an option, what would they be?
A would be understand who you're bringing to the table to acquire a mezz fund for you. Okay, what do they specialize in? Get to know them as a company first. What is their strategy as a company? What are their success rates? Understand that. Understand, 2 would be to understand the mezz company that you're bringing to the company to lend money into you. What do they specialize in? What are their track records? Mm-hmm. Okay, and then 3 would be don't put expectations in your book that you don't think you're going to fit. Because if you can't meet those expectations, it's just going to be a very difficult journey for you. So getting the right advisor up front is probably the first, most foremost thing, and that will lead the other 2 to help make their own decisions.
So you heard it here, Michael Casalini. He has increased his business 5-fold. He's done it with 2 different mezzanine lenders. So you want to make sure that you are doing your homework as to who is representing you in terms of their strategy and how they try to bring in financing for you. Number 2, the mission of the mezzanine fund and making sure that it's compatible with your internal growth strategy. And number 3, you want to be realistic in terms of your business plan and your confidential memorandum so that you're putting out information that reasonably and accurately represents where you are and where you're going. And if you do that and you put a lot of time and effort into it, you'll have a successful mezz raise yourself. Well, Michael, I want to thank you very much.
Thank you.
It was very informative. Thank you in the Track Capital universe for watching, and we'll be back with another webinar next month. Have a great day, everybody.